Ever feel like the financial headlines are just, the tip of the iceberg?
Oh, absolutely. There's always so much more going on underneath, isn't there?
Exactly. And today we're diving deep beneath the surface to explore a topic that's, well, it's rapidly reshaping the financial landscape for individuals and businesses across the UK.
Ah, you mean the evolving powers of Revenue and Customs, HMRC?
That's the one. We're talking about their new and maybe re-emphasized abilities to collect unpaid taxes, to get access to crucial financial information.
And the significant debate around it all, often quite heated, actually.
Right. What this truly means for you, the taxpayer, and, for the very structure of our financial system.
Indeed. And our mission for you today, our curious listener, is really to untangle the intricacies of these, well, quite profound changes.
Okay.
We've compiled a comprehensive stack of recent sources, everything from government policy papers and official guidance, right through to detailed reports from leading tax advisory bodies and some sharp news analyses.
So quite a range.
Definitely. Our goal is to help you grasp not just the what and why of these developments, but crucially, the so what for your own financial life.
Right, the practical impact.
Exactly. We'll explore precisely how these powers are being strengthened, what safeguards are supposedly in place.
Supposedly being the operative word, perhaps?
Well, we'll look at what's stated and also the significant concerns being sometimes vehemently raised by a wide array of professional bodies and civil liberties groups, too.
Okay.
It's really a journey into the heart of tax administration and its deeply personal impact.
And we've pulled together quite a rich tapestry of information for this deep dive, haven't we?
We have.
Our sources include official gov.uk documents, specifically those policy papers on direct recovery of debts and the guidance for vulnerable customers. We've also drawn insights from specialist tax publications like ETC Tax and rossmartin.co.uk, parliamentary committee reports from the UK Parliament.
Those are always revealing.
And articles from regional news outlets like Devon Live and Birmingham Live. Crucially, we're also bringing in the expert perspectives and critiques from the Institute of Chartered Accountants in England and Wales, ICAEW.
A key voice.
And legal insights from firms like Slaughter and May. So it's a diverse and, I think, fascinating collection. We're excited to pull out the most important threads for you.
Definitely. But before we truly dive in, a quick but really crucial note.
Ah, yes, the necessary disclaimer.
Absolutely. This deep dive is purely for informative purposes. It should absolutely not be considered financial or legal advice.
Right.
Tax matters are inherently complex. They're highly specific to individual circumstances. We always recommend consulting with a qualified financial or tax professional for your unique situation.
Couldn't agree more. Get proper advice.
And as always, this deep dive is brought to you by the dedicated team at Expert Trader UK, committed to bringing you clear, comprehensive, and hopefully accessible insights into these vital topics.
Okay, great. With that essential groundwork laid, let's now truly dive into the first significant development. The return, or perhaps the re-energizing, of direct recovery of debts.
DRD.
DRD. So today we're unpacking the significant re-emphasis on HMRC's direct recovery of debts, DRD. Essentially, their power to directly debit funds from bank accounts without needing a court order first.
Which sounds quite drastic on the face of it.
It does. And while it's not entirely new, its renewed focus signals, well, a profound shift in HMRC's enforcement toolkit. Can you clarify exactly who HMRC says this is aimed at?
Certainly. HMRC has been actually quite explicit about its target group here.
Okay.
They state that DRD is intended for, and I quote, a small number of individuals and businesses who are making an active decision not to pay or to delay paying the money they owe.
An active decision.
Even though they have sufficient funds in their bank and building society accounts. That's the crucial distinction they're making.
Right. So not people who can't pay, but people who won't pay, even though they supposedly can.
That's the official line. From HMRC's perspective, this isn't about those who are struggling or genuinely unable to pay. The emphasis is very much on that phrase active decision, implying deliberate noncompliance.
Okay.
They underscore that the vast majority of people pay their taxes in full and on time, suggesting this power is a scalpel for a resistant, financially capable minority, not a blunt instrument for the general populace.
And this isn't a completely novel concept for the UK, is it?
Yeah.
I think Devon Live pointed out that these provisions were actually first put in place. When was it?
Back in 2015, yes, by the conservative government.
Right, 2015. But then they were put on hold during the pandemic.
Exactly. They were paused amidst the pandemic crisis.
So what's prompted their reinstatement now, post-pandemic?
Well, that's an excellent question, and it really speaks to a broader strategy, I think. The original intention back in 2015 was clearly to give HMRC a more efficient tool for debt recovery. But obviously, the pandemic brought an unprecedented economic crisis. There was a clear governmental reluctance, you could say, to introduce such an aggressive debt recovery power when so many individuals and businesses were facing severe financial distress.
Understandable.
Reinstating it now signals a shift in focus back towards debt collection efficiency. It reflects that post-pandemic drive to shore up public finances and, crucially, reduce the tax gap.
Okay.
It's a move from crisis response back to what HMRC likely views as standard, albeit strengthened, enforcement.
So the immediate economic context is a big part of it. But there's also a significant international dimension mentioned, isn't there? Something about the rationale behind DRD's resurrection.
Yes, ETC tax highlighted HMRC's desire to deal more efficiently with information requested from overseas tax authorities.
Ah, right. What's the background there? Why was that an issue?
This point is really quite fascinating because it ties into global tax cooperation and the UK's position within that whole framework. Historically, the UK was somewhat unique among G20 members. HMRC required either tribunal approval, FTT approval, or the taxpayer's direct consent before issuing third-party notices to banks for information related to overseas tax requests.
So an extra step compared to others.
Exactly. And this was seen as a significant hurdle, potentially slowing down international efforts to tackle cross-border tax evasion.
And that hurdle led to some pretty substantial practical delays, didn't it? The sources mentioned, 12 months on average?
That's right. On average, it took HMRC 12 months to produce this type of information, which is actually double the internationally agreed target of 6 months.
Wow, double. So from HMRC's viewpoint, this change is about streamlining and efficiency, especially in that global context where they're trying to align with international standards and, meet their obligations.
Absolutely. The perception from HMRC's side, certainly, is that these delays made the UK less effective in contributing to international efforts against tax avoidance and evasion. By removing the need for FTT approval for certain information notice, specifically these financial institution notices we'll come on to, they believe they can drastically cut down that 12-month average.
Making them more responsive.
Yes, enhancing their responsiveness and cooperation on the global stage. It's a move designed to make the UK a more effective partner in international tax enforcement, essentially.
Okay, that makes sense from their perspective. But let's connect this back to the bigger picture. Devon Live reported that the resurrection of direct recovery is a strategic move within a larger scheme aiming to boost tax revenues by an additional £1 billion.
£1 billion, yes, specifically over the next 5 years.
That's a significant figure. What are the key areas they are targeting to achieve this? Is it just general debt?
Well, that $1 billion target is indeed substantial, and it reflects the Treasury's intense focus on revenue generation post-pandemic. A key target area, and one that directly links to DRD, is addressing what they call Treasury concerns regarding numerous savers neglecting to pay taxes on interest income.
Savings interest. That feels quite specific.
It is. It makes the interest earned on savings a primary focus for these expanded DRD powers, or at least the supporting information gathering powers. This is particularly salient given the recent rise in interest rates, isn't it?
True. Interest rates have shot up.
Which means more people are earning significant interest on their savings, perhaps more than they realize, and possibly more tax liabilities are arising for those who exceed their personal savings allowance.
Okay, so that $1 billion target looms large. But this power, DRD, sounds pretty potent. How does HMRC ensure it's not just a free-for-all? What are the key safeguards they say are in place to protect taxpayers?
Right, that's crucial. HMRC has outlined several foundational safeguards to, at least attempt to mitigate concerns about arbitrary use.
Such as?
The most prominent one is that HMRC ensures that action is taken only when a taxpayer's accounts total at least £5,000.
Okay, a £5,000 minimum balance across all accounts.
Exactly. This isn't about emptying someone's account entirely, nor is it supposedly about targeting those with minimal savings. It's designed, they say, to focus on individuals or businesses with demonstrable liquidity.
Right. And what else?
Furthermore, funds are only recovered after exhaustive efforts to reclaim the debt through letters and phone calls have failed. That's the official process.
Exhaustive efforts. So it's meant to be a last resort.
It's meant to be a last resort, yes. Coming into play only after all other conventional communication and collection methods have been thoroughly exhausted. It implies a significant period of engagement, or at least attempted engagement, before DRD is even considered.
And there's a very specific commitment regarding vulnerable customers, isn't there? That feels like a really important ethical consideration here.
Absolutely critical. The government has been quite clear, in its policy statements at least, that DRD should not apply to vulnerable customers. This includes those who need additional assistance for whatever reason.
And that's written into the rules.
Yes, this commitment is more than just a guideline. Apparently, it's woven into the very fabric of the DRD legislation. It includes a specific commitment for HMRC to consider whether someone may be at a particular disadvantage in dealing with their taxes before making a decision whether to proceed.
Okay, that sounds significant. A particular disadvantage.
It's a statutory promise intended to provide a robust layer of protection. The aim is to ensure the power isn't applied indiscriminately to those who genuinely struggle to engage with the tax system due to specific, identifiable vulnerabilities. It's meant to be a crucial legal and, well, moral underpinning to the policy.
So who exactly might be affected by this, particularly with this renewed focus? It seems like a lot of the emphasis, as Devon Live pointed out, is expanding to untaxed interest earnings on savings. Could this catch a lot of people by surprise?
This is where the practical implications become very real for the average saver, I think. The government is contemplating enhancing the integration of tax payments and payroll systems.
How would that work?
Well, it could grant HMRC the capacity to promptly adjust payo tax codes, enabling what they call seamless and immediate tax retrieval on savings interest.
Wow. Immediate retrieval through your tax code.
Potentially. Traditionally, savers either had tax deducted at source by banks, or they had to report their interest income through self-assessment if it exceeded their personal savings allowance.
Right.
This new mechanism could mean that your employer's payroll system, via adjustments to your pay tax code, could now effectively collect tax on your savings interest in real time.
So less take-home pay, potentially without you fully realizing why immediately.
That's the risk. If you're not meticulously tracking your tax code or diligently monitoring your interest accruals against your allowance, you might see unexpected reductions in your take-home pay. Or you could even find yourself underpaying tax by year-end if the system isn't perfectly calibrated to your circumstances, leading to a bill later.
Okay, here's where it gets really interesting. What does this mean for the average person with savings? Is this going to impact everyone with a bit put away, or is it genuinely targeted? The emphasis in the sources is on those financially capable of settling their tax obligations, but choose not to do so. But as we just discussed, the mechanism for savings interest sounds like it could potentially ensnare people who simply aren't aware they owe anything.
That's precisely the crux of the tension, isn't it? HMRC's stated intention is clear. Target deliberate non-payers, those with the means and the conscious intent to avoid their obligations.
What?
But as financial specialists like Sarah Coles of Hargreaves Lansdowne have highlighted, many taxpayers are, frankly, oblivious to their tax liabilities on savings.
Why is that?
Because they're used to banks handling the tax below a certain level, or they simply don't understand their personal savings allowance or how interest income interacts with their tax code, especially now, rates are higher.
It can be confusing.
It really can. So this new, more rapid system of reporting and deduction could lead to unexpected bills or deductions that people genuinely struggle to understand, let alone pay. It truly highlights the gap between HMRC's stated intent targeting a deliberate resistant minority and the very real potential for unintended consequences hitting a much broader group.
People who are just unaware or confused rather than actively choosing non-compliance.
Exactly. It's a crucial distinction and one that needs incredibly careful navigation in practice.
Building on that point about vulnerable customers, HMRC has actually published quite detailed guidance on how they intend to identify and support these individuals under DRD. It sounds like they're trying to be very methodical about it.
Yes, which is reassuring to see, at least on paper. The government has explicitly committed to including stringent safeguards to ensure that adequate protection is in place for those vulnerable customers. The intent stated is clear. Those identified as vulnerable will not be considered for DRD and will receive alternative support instead. This is presented as a crucial policy pillar.
To stop the power being used indiscriminately.
Precisely. Particularly against those who, through no fault of their own, are struggling to manage their financial affairs.
And it's good to see that, according to the gov.uk policy paper, the government is extremely grateful to those organizations who have helped shape this guidance. They mentioned getting input and advice on earlier drafts.
Yes, that collaboration is key. It aims to integrate real-world understanding of vulnerability into the policy framework. And it led to this detailed structure outlining 4 crucial indicators HMRC must consider when assessing if a debtor is at a particular disadvantage in dealing with their tax affairs.
4 indicators. Okay.
And these aren't just tick boxes, apparently. They're designed to prompt a more holistic assessment of the individual's circumstances.
So let's dive into those indicators. What exactly are they looking for to identify a vulnerable customer?
Okay, the first one, indicator A, is a disability or long-term health condition. And this extends beyond just physical disabilities. It encompasses mental health conditions or learning difficulties that directly impact a debtor's ability to communicate effectively with HMRC, or perhaps to manage their financial affairs, preventing them from understanding their indebtedness.
So things like severe anxiety, perhaps.
Exactly. Or learning difficulties making complex forms impenetrable. The guidance acknowledges that these effects can be temporary or lifelong, requiring flexible responses.
Okay, that's A. What's B?
Then there's indicator B, which covers a temporary illness, physical or mental health condition.
So short-term issues.
Yes. The example given is being diagnosed with a serious illness or condition that affects someone to such an extent that they are temporarily unable to understand their indebtedness or put their HMRC affairs in order. It recognizes that even a short-term acute health crisis, like a sudden stroke, maybe, or debilitating injury, can severely impair capacity.
Got it. And C.
The third, indicator C, focuses on personal issues. These are broader life events that could overwhelm someone to the point where they could not understand or cope by themselves.
Like what sort of things?
The specific examples provided paint a very human picture. Becoming recently widowed, experiencing a family bereavement, being made redundant, facing a serious illness themselves, managing significant caring responsibilities, or suffering trauma from an assault or domestic or financial abuse.
Wow. Quite a range of difficult circumstances.
And critically, these issues can affect the individual directly or someone close to them, like an immediate family member. It highlights the ripple effect of personal crisis on financial management.
Okay. And finally, indicator D.
Finally, indicator D hones in on lower levels of literacy, numeracy, and NORD education.
Right.
This refers to situations such as learning difficulties. That means someone is simply unable to fully understand their indebtedness or the tax process without specific advice or dedicated support. It acknowledges that educational background or cognitive abilities can genuinely impede someone's capacity to comply.
So 4 broad categories. Sounds like it's not just about ticking boxes. There's a really nuanced judgment involved here. The guidance specifically asks, the question to what extent the disadvantage or vulnerability identified affects P's ability to deal with their revenue and customs affairs is critical.
Exactly. That judgment is key.
How does this judgment then shape HMRC's response?
Yeah.
What happens next?
Precisely. The HMRC official's judgment based on these indicators is meant to lead to 2 distinct paths.
Okay.
Path 1. If the disadvantage is judged to hinder a person's capacity to understand or deal with their tax affairs, then that person will not be considered for DRD. Full stop.
And instead?
Instead, they'll receive alternative tailored support. That could involve more accessible communication methods, extended deadlines, maybe referral to specialist HMRC teams, or even third-party advisory bodies.
Okay, that's path 1. What's path 2?
Path 2. If the official judges that the person is at a disadvantage, but it does not significantly hinder their capacity to understand or deal with their tax affairs, then HMRC may still proceed with DRD, but they must consider making reasonable adjustments.
Reasonable adjustments like what?
That could mean, for instance, delaying the process for a limited time to allow the person to get assistance, or maybe communicating exclusively through a nominated representative like an accountant or advisor.
Right.
And importantly, there's a further check. If the official judges that the disadvantage is unlikely to improve in the foreseeable future, then again, the person will not be considered for DRD and will be offered longer-term alternative support.
So it tries to account for temporary versus permanent issues.
Exactly. The framework is a conscious attempt, at least in theory, to tailor the response based on the nature, severity, and longevity of the vulnerability, aiming for proportionality and empathy.
To truly understand how these indicators translate from policy to practice, the gov.uk paper provides a compelling real-world scenario. Can you walk us through John's situation and how this framework would apply?
Of course. It's a useful illustration. The case study introduces John, who is suffering from post-traumatic stress disorder, PTSD. Okay.
This condition was triggered by an incident at his previous employer, and it's unfortunately left him unable to work, meaning he has no regular income.
A really tough situation.
And it's compounded. He already has a substantial charging order against him. His benefits have recently stopped, so his financial situation is deteriorating rapidly.
Right.
And then, into the midst of this overwhelming personal crisis, a demand for a tax bill arrives. This adds immense stress and confusion, as he's already struggling to cope but apparently has no support network.
You can see how that would be completely overwhelming. It touches on multiple vulnerability indicators, doesn't it? Mental health, personal issues, lack of income.
Absolutely. It ticks several boxes, clearly.
So in a situation like John's, what does this all mean for him? How should HMRC respond according to their own detailed guidance?
Well, according to the guidance, the HMRC officer assessing his situation, recognizing those clear indicators of vulnerability, the severe mental health impact, loss of income, existing debt, lack of support, should immediately refer him to specialist support teams within HMRC. Specialist teams.
Yes. Teams apparently equipped to deal with complex vulnerability cases with a more empathetic and flexible approach. Their primary goal wouldn't just be collecting the debt.
What then?
It would be to consider the best way to help John get his affairs in order. This might involve pausing the debt collection process entirely, maybe setting up a very manageable payment plan that considers his lack of income, or helping him understand his tax obligations in a much simpler, more accessible way.
Okay.
And crucially, John might also be signposted to a third-party organization or charity, perhaps a debt advice charity like Step Change or Citizens Advice, or a mental health support service to help him organize his non-tax financial and personal affairs, too.
So a more holistic approach.
Exactly. It illustrates the intended human element in the process, a recognition that some situations require a supportive, joined-up approach, rather than just a blunt demand for debt recovery. It aims to prevent the tax system from, actively worsening an already dire personal crisis.
That's a powerful example of the intended protective measures. But okay, beyond direct recovery, HMRC's reach is also extending into how they obtain information about your finances in the first place.
Ah, yes, the other side of the coin.
Let's pivot to the equally significant and perhaps even more controversial financial information notices, or FINs. These are new proposals that, as ETC Tax describes it, make it easier for HMRC to obtain information about taxpayers from financial institutions such as banks.
Yes, this represents a really significant shift from the current state of play.
How so? What was the old system?
Previously, for HMRC to get information from a financial institution, a bank, say, concerning your affairs, they needed to issue what's called a third-party notice.
Right.
And crucially, this process required either your agreement as the taxpayer or, if you didn't consent, approval from the first-tier tribunal, the FTT.
So an independent check.
Exactly. The FTT acted as an independent judicial oversight. It was a vital safeguard against speculative or overly broad information requests, effectively stopping HMRC from going on fishing expeditions into people's private financial data without good reason.
And these notices were used for?
Primarily for HMRC's own inquiries into a taxpayer's compliance, or sometimes for information requested by overseas tax authorities as part of international agreements.
Okay, so the proposed change is quite stark then. The new rules will allow HMRC to issue a financial institution notice, FET, to a financial institution without HMRC first having to obtain the approval of the first-tier tribunal, FTT, or the taxpayer.
Correct.
That removes a pretty big hurdle for HMRC, doesn't it? A significant safeguard, as you said.
Clearly, yes. It removes a fundamental safeguard from the current rules. The reasoning given for this, as articulated in the sources, is primarily about streamlining the process, particularly for those international information requests we mentioned earlier.
Because the UK was lagging behind.
Apparently so. The UK was reportedly the only G20 member still requiring that tribunal approval or taxpayer consent for such third-party notices. HMRC contended this requirement meant it took them, on average, that 12 months to produce requested information for international partners.
Double the target time.
Exactly, twice the internationally agreed target of 6 months. So from HMRC's perspective, this change is about administrative efficiency and aligning with global norms. It's about responding more quickly to international demands and thereby, they argue, reducing global tax evasion.
Okay, so how do these FINs actually work now, and what's their scope? If tribunal approval is removed, who approves them internally? Is there any check?
Well, while that external judicial oversight is gone, a FIN must still be approved by an authorized HMRC officer. So there's an internal check.
An internal HMRC check.
Yes, designed to ensure the request meets certain criteria. The applicable test for what information can be requested is whether, in the reasonable opinion of that HMRC officer, the information is of a kind that it would not be onerous for the financial institution to provide or produce.
Not onerous for the bank. That sounds a bit subjective.
It does set a somewhat subjective bar, yes,
Yeah.
aimed at preventing excessive burden on banks, but still leaving considerable discretion to HMRC officers.
And it's not for just any third party, correct? The name says financial institution notice.
That's absolutely right, and a crucial clarification. These new notices only apply where the intended recipient is a financial institution and not just any third party.
So banks, building societies.
Yes. Banks, building societies, similar regulated financial entities. It doesn't, for instance, extend to your employer or your utility provider or other general businesses you deal with, unless they also happen to fall under that specific definition of a financial institution.
Okay. So that limits its immediate scope. But the principle of direct access without external oversight remains the key change.
Precisely.
Given the removal of that independent tribunal oversight, what safeguards remain for the taxpayer? And what happens if a financial institution doesn't comply? Can the taxpayer appeal?
This is where it gets particularly concerning for critics. The recourse for taxpayers themselves is extremely limited.
How so?
There is no right of appeal against a fine for the taxpayer directly.
No appeal at all.
The only way to challenge the notice itself is by way of judicial review.
And judicial review is?
As ETC Tax notes, this could prove expensive. For the average individual, judicial review is a high-stakes, legally complex, time-consuming, and yes, often prohibitively expensive route.
So not really a practical option for most people.
Not easily, no. It means the burden of challenge shifts significantly and practically onto the individual, effectively removing any accessible, affordable, or rapid avenue for appeal against the notice itself.
Is there any transparency? Does the taxpayer even know this is happening?
Generally, yes. The taxpayer will receive a copy of the notice and a summary of reasons why the information is required. So transparency is the default rule.
But, I send a but.
There is a catch. The FTT can decide that this requirement can be waived.
Waived, meaning the taxpayer isn't told.
Exactly. In certain circumstances, if the tribunal deems it necessary, perhaps, to prevent the taxpayer from destroying evidence or alerting others involved in, say, a fraud scheme, the taxpayer might not be notified that their financial information has been requested and obtained.
That's quite something. Are there any other limits?
Well, yes, the usual restrictions that apply to a general Schedule 36 information notice also apply to FNs. For example, a person or institution is only required to produce something that is genuinely within their possession or power. They can't demand information the bank simply doesn't hold.
Okay. And if a financial institution fails to comply with the FN, what happens to them?
Failure to comply with the FN may result in a penalty being imposed on the recipient of the notice, so the bank itself.
And can they appeal?
Yes. In this case, there is a right of appeal against that penalty. This is a crucial distinction. The financial institution can appeal the penalty levied against them for noncompliance, but the individual taxpayer cannot directly appeal the issuance of the notice that targets their information.
Got it. When are these changes expected to come into effect? Are they active now?
They are proposed to come into effect for any notices that are issued after the next finance bill receives royal assent.
Okay, so dependent on the legislative timetable.
But what's critically important to note here is the timing aspect. It's the date the notice is issued, not when the underlying tax matter occurred.
Meaning?
This means that FIN could relate to a matter which arose well before FINs came into force. It could potentially give HMRC retroactive access to information for older tax issues that predate the very existence of these FIN powers.
Wow. That retrospective application certainly adds another layer to the privacy concerns for some critics.
It absolutely does.
This expansion of powers for HMRC isn't happening in a vacuum, is it? Broader concerns are being raised about what some are calling snooping powers and maybe the emergence of an increasingly intrusive state.
That's right. It feels like part of a wider trend.
It's not just about tax collection anymore. It touches upon fundamental issues of privacy and civil liberties.
Absolutely. The Birmingham Live article you mentioned explicitly warns of HMRC and Department for Work and Pensions, DWP's mid-ranking officials, being handed powers that are usually reserved for police investigators.
DWP as well, so benefits too.
Yes. This isn't merely about data requests. It signifies a wider, more direct shift in enforcement capabilities across government departments, extending far beyond the traditional remit of just tax matters. We're seeing a convergence of powers, you could say.
Powers usually held by the police.
Now being wielded by administrative bodies.
And what exactly do these new powers entail for these officials? What does it look like in practice?
Well, under a new fraud bill that's been discussed, these officials could potentially extract funds if they reasonably believe that money is owed.
Extract funds directly, based on reasonable belief.
That's the proposal cited. A significant leap from simply requesting information. It allows for direct intervention in personal finances based on an official's belief. Furthermore, they could ask for a search and entry warrant and to freeze bank accounts.
Search and entry warrants. Freezing accounts. That really does sound like police powers.
It moves firmly into territory traditionally associated with serious criminal investigations, allowing officials, who are not police officers, to potentially access private premises and immobilize financial assets. This has, quite naturally, framed a significant public debate.
And privacy campaigners have weighed in heavily, haven't they? The article calls it a snooper's charter. That's pretty strong language.
It is indeed. The sentiment among civil liberties groups seems quite clear. They feel civil servants have been handed the power to spy on public's bank records. The campaign group Big Brother Watch described these as dangerous new bank spying powers.
What was their reasoning?
They argued it would effectively turn banks into agents of the state, tasked with spying on everyone's bank accounts and reporting back to the government. That's a powerful statement about the perceived erosion of financial privacy.
Implying a chilling effect.
Yes, suggesting a scenario where every transaction could theoretically be subject to governmental scrutiny without robust, independent oversight.
And it's not just civil liberties groups raising the alarm, is it? Members of the House of Lords have also expressed serious concerns.
Very much so. Lord Vaux, a crossbench peer, for instance, stated that these measures would give severe police powers to relatively junior civil servants in the Cabinet Office.
Relatively junior civil servants.
He didn't mince words. He delivered a chilling observation. If handing police powers to civil servants was not chilling enough, here are powers that facilitate the state raiding bank accounts. His concern highlights a fundamental constitutional question about the appropriate distribution of such potent state power.
And whether it should reside outside traditional law enforcement and judicial frameworks.
Precisely. Baroness Finn also vociferously opposed the bill, pointing out that these powers could be exercised without public record or the consent of Parliament.
No public record.
That was her concern. She raised a critical question that cuts to the heart of accountability. How these powers are used, by whom, and under what form of oversight. It really goes to the core of transparency in a democratic system.
Questioning whether adequate checks and balances are in place when such significant powers are delegated.
Exactly.
Beyond parliamentary and civil liberties circles, the financial sector itself is showing anxieties. What are their main worries about this perception of an increasingly intrusive state?
Well, John O'Connell, chief executive of the Taxpayers Alliance, voiced a common sentiment. Taxpayers will be rightly nervous about the growing tentacles of the taxman, particularly given the authoritarian nature of this new power.
That feeling of being watched.
Yes, the concern isn't just about specific overreach. It's about the feeling of increased governmental control over individual financial autonomy, fostering a sense of being perpetually under surveillance.
Okay. Any other perspectives from the financial world?
Jason Hollins, managing director at Evelyn Partners, highlighted both practical and systemic issues. He remarked that things like direct deductions and effectively turning employers into tax collectors for sources of income they are not responsible for.
Like the savings interest point.
Exactly. He said it raises serious issues about an increasingly intrusive state and the potential for errors to go unnoticed when buried in payslips.
So a double risk, privacy and errors.
Yes. Not only privacy concerns, but also the potential for increased administrative burden on employers and a heightened risk of errors in a complex system. It makes it harder for individuals to track their own tax affairs accurately.
And we heard earlier from Sarah Coles at Hargreaves Lansdowne, too.
Yes, she brought up the potential for taxpayers to be caught entirely unaware, suggesting many may be oblivious to their tax liabilities on savings, perhaps because they're used to different reporting mechanisms.
Leading to being caught off guard.
Exactly, caught off guard by unexpected real-time deductions or surprise bills, potentially causing significant financial distress for those who genuinely struggle to manage their money or understand complex tax rules.
So with all these significant concerns being raised from across the political spectrum, civil society, the financial sector, how is the government defending these expanded powers? What's their counterargument?
Well, a DWP spokesman countered these arguments by framing them within a larger strategic imperative. They said, "We are bringing forward the biggest fraud crackdown in a generation as part of wider plans that will save $9.6 billion by 2030.
$9.6 billion. That's a huge number.
It is. It frames the measures as absolutely essential for tackling large-scale fraud and securing public funds, positioning them as a necessary step to protect the public purse.
So it's about necessity and modernization.
That seems to be the core message. They reiterated their stance that it is right that we modernize our approach to catching fraudsters and identifying overpayments at the earliest stage.
And addressing the snooping fears directly.
Yes. Crucially, to counter that snooper's charter narrative, they stated, all the powers in the bill are underpinned by a principle of fairness and proportionality and do not involve mass surveillance of people's bank accounts. The government's defense centers on the necessity of these powers to combat fraud and safeguard taxpayer money, coupled with assurances, and time will tell how these play out, that they will be used responsibly, proportionately, and specifically against identified wrongdoing, not for broad, indiscriminate surveillance.
A delicate balancing act they're trying to maintain between perceived efficiency and public trust.
Precisely.
Okay, moving on from those broader concerns, let's get a crucial professional perspective. The Institute of Chartered Accountants in England and Wales, ICAEW, is a leading voice representing tax professionals. They've issued some strong critiques of HMRC's evolving powers.
Yes, and their insights are particularly valuable because they sit at the interface, understanding both the practicalities of tax administration and the needs and concerns of taxpayers and businesses.
So what's their overall take?
Well, ICAEW has warned quite starkly that the government's plans to tackle tax advisors facilitating noncompliance are, in their view, poorly targeted and could adversely affect the operation of the tax advice and compliance market in the UK.
Poorly targeted?
Yeah.
How so? They support tackling bad advice, surely.
Oh, absolutely. They unequivocally support reasonable, properly targeted, and proportionate measures to tackle poor or dishonest advice. No question about that.
What?
But they believe the proposed changes go too far, are fundamentally disproportionate and poorly targeted. Their primary concern is that these measures risk creating a quasi-regulatory environment where HMRC effectively acts as judge, jury, and executioner for tax advisors.
HMRC regulating the advisors.
That's the fear. And they believe this could negatively impact the UK's tax market as a whole.
So their core argument is that these measures, while perhaps well-intentioned and aiming to catch the genuinely dishonest few, might actually be contrary to the public interest because of their wider unintended consequences.
That sums it up well, yes.
How do they explain this idea of disproportionate and poorly targeted measures in more detail?
ICAEW argues that the new proposals effectively extend draconian provisions, very harsh measures that were originally designed for clear cases of dishonest conduct, to now apply to behaviors that fall well short of dishonest conduct.
Lowering the bar for intervention.
Exactly. That lowering of the threshold is a major concern. The fear is that this will lead to HMRC coming under pressure to use its powers more widely in the future than initially intended. It blurs the lines between genuine fraud and maybe simple errors, or perhaps aggressive but still technically legal tax planning.
So they want clearer definitions.
Urgently. They emphasize the need for clarity, stating that the term non-compliance should be clearly defined. For example, defining it specifically as tax advisors actively and knowingly facilitating and promoting non-compliance that results in a loss of tax. Without that clarity, the risk of misapplication just increases significantly.
You mentioned their concern about HMRC acting as a quasi-regulator. What's the issue there?
What's particularly insightful here is ICAEW's point about trust. They warn that HMRC acting as a de facto regulator, especially given what they see as a clear conflict of interest, being both the tax collector and the arbiter of professional conduct,
tricky combination,
could further erode the trust that taxpayers and advisors have in the tax system. This is a fundamental challenge. A healthy tax system relies heavily on a degree of mutual trust and cooperation.
Between the tax authority, taxpayers, and their advisors.
Precisely. If advisors feel unduly targeted or constantly under suspicion for just doing their job, it can break down that collaborative environment, making genuine compliance actually more difficult in the long run.
That's a powerful point about eroding trust. What about the direct impact on the tax market itself? How do they see these proposals affecting the provision of tax advice for everyday people and businesses?
They're deeply concerned here. ICAEW fears these proposals could adversely impact the operation of the UK tax market and make it harder for taxpayers to obtain tax advice from a reputable tax advisor at a reasonable price.
Harder to get advice. Why?
They foresee a potential ripple effect across the profession. They suggest some compliant tax advisors may even exit aspects of the tax advice and compliance market, particularly those dealing with complex or perhaps borderline cases, simply due to the increased perceived risk and the compliance burden involved.
So good advisors might just say, it's not worth the hassle or the risk.
That's the fear.
And what would be the practical consequences of compliant advisors potentially stepping away or becoming much more cautious?
Well, this could lead to a cascading series of negative outcomes, according to ICAEW. Firstly, potentially increased costs for taxpayers and reduced access to services, as fewer advisors might mean higher fees and longer waits.
Right. Supply and demand.
Which in turn could slow down transactions and decision-making and hinder growth across the economy, as businesses and individuals find it harder and more expensive to get the timely advice they need. And paradoxically, ICAEW argues it could also put more pressure on HMRC at a time when it's struggling to improve its own performance. Imagine more taxpayers trying to navigate complex rules or correct errors without professional help.
Yeah, potentially leading to more mistakes.
Exactly. And ultimately, this could actually reduce compliance and increase the tax gap by making proper tax management more difficult and less accessible for the majority. It's a stark warning.
That overregulation could inadvertently backfire, creating more problems than it solves.
Precisely their argument.
Digging deeper into the information gathering side, ICAEW has specific concerns about how HMRC might obtain information, particularly that reasonable suspicion threshold for issuing conduct and information notices. They describe this as a very low bar.
Yes, they argue this threshold is problematic. They actually compare it to stop and search powers in policing.
Really?
Suggesting it's relatively easy for HMRC to initiate an inquiry based on mere suspicion, even if that suspicion turns out later down the line to be factually incorrect.
So HMRC might suspect something, but be wrong.
Exactly. They state that HMRC may reasonably suspect, but be factually wrong. And while an advisor can challenge this on appeal, potentially leading to the cancellation of a notice, the significant concern is the damage done in the meantime.
How so?
The worry is that reputational damage to an advisor's practice may already have been done by that stage, simply by the fact of the inquiry being launched and potentially becoming known. The harm isn't just financial, it's reputational, which is, frankly, existential for many professional practices.
A very serious concern for advisors. And a major point of contention seems to be the removal of tribunal approval for file access notices, which we discussed earlier in the context of villains. ICAEW holds a strong view on this, don't they?
They are quite firm on this point, yes, viewing it as a critical erosion of independent oversight. They state clearly that they do not consider that delay in the current judicial process is a valid reason for changing the decision-maker from being an independent tribunal to HMRC.
So efficiency isn't a good enough reason?
Not in their view. Not when it removes independent oversight. They believe it's entirely inappropriate for an HMRC officer to have this role, as they are not truly independent. They are part of the body seeking the information.
So what do they suggest instead?
They strongly advocate for retaining tribunal approval, or, if it absolutely must be removed for reasons of efficiency, replacing it with some other form of independent decision-making process, perhaps a committee with non-HMRC members to provide adequate oversight and a check against potential overreach or bias.
Okay. They also mentioned something about a level playing field. What's that about?
Ah, yes. Another specific concern they highlight, particularly concerning legal professional privilege.
How lawyers' advice is protected.
Exactly. If these information notice powers are expanded, ICAEW warns there's a risk of widening the gap between the professions. Because, under UK law, legal advice privilege generally protects communications between a lawyer and their client from disclosure, even to authorities like HMRC. Other professional advisors, like accountants, typically don't have that same level of privilege for tax advice communications.
So accountants' advice isn't as protected.
Generally, no. Their client communications can often be compelled by HMRC. ICAEW's concern is that expanding HMRC's information powers without addressing this disparity could inadvertently push taxpayers towards using more expensive legal advice simply to ensure confidentiality.
Or make it harder to get comprehensive advice from their usual accountant.
Precisely. Or just make it harder for the majority to get comprehensive, confidential tax guidance from their preferred, often more affordable, non-legal advisors, they state. There must be a level playing field between all tax advisors, whether or not legally qualified. Otherwise, there is a danger that the policy intent will be undermined by more taxpayers seeking tax advice from legally qualified advisors. This could lead to higher costs for taxpayers and potentially a reduction in overall quality or accessibility if the market becomes imbalanced.
Interesting point.
Okay.
Beyond information gathering, ICAEW also have significant concerns about the proposed financial penalties for non-compliance by advisors. What are they questioning here? Is it the amounts?
It's partly the amounts, but also their effectiveness and fairness. What's fascinating here is ICAEW's nuanced view on the deterrent effect.
How so?
They note that the current maximum penalty of £50,000 for dishonest conduct could be seen by some tax advisors as an acceptable cost of doing business rather than an effective deterrent, at least from HMRC's perspective, perhaps aimed at the real rogues.
Right.
However, ICAEW counters that for the vast majority of tax advisors providing professional services subject to PCRT professional conduct in relation to taxation, a fine of this size would never be seen as an acceptable cost of doing business. It would be devastating.
So a disconnect in perception. What HMRC sees as a deterrent for the bad apples
Might be seen as a disproportionate and potentially career-ending sum for the vast majority of compliant professionals who might make an honest mistake under complex rules.
And what about penalties that are linked to the tax lost or even a business's global turnover? Those sound like they could be enormous.
They certainly could. ICAEW views penalties based on the potential revenue lost or a business's global turnover as wholly disproportionate.
Why disproportionate?
Their argument is that such penalties could reach astronomical figures, completely unrelated to the advisor's actual fee or culpability. This, they fear, would mean taxpayers with large tax liabilities may be unable to access proper advice, as tax advisors could deem the work too risky.
So advisors might just refuse complex, high-value work.
Imagine a tax advisor potentially facing a penalty tied to a multi-million-pound transaction, even if their error was relatively minor or debatable. The level of risk aversion could lead reputable advisors to simply refuse to take on clients with significant tax affairs.
Which, paradoxically, could leave those taxpayers without proper guidance, potentially increasing errors and noncompliance.
Exactly the paradox they highlight.
So what do they suggest as alternatives for penalties?
They suggest penalties should ideally be proportionate fixed sum amounts or be linked to a tax advisor's fees, ensuring they are punitive and a deterrent, but without being existential threats to a professional practice for anything less than deliberate fraud.
They also touch on potential human rights implications with these penalties, didn't they?
Yes, briefly but significantly. ICAEW highlights the human rights law consequences of imposing potentially disproportionate penalties, especially if they are imposed without robust, independent court approval or oversight.
Elevating it beyond just financial consequences.
Yes, to a fundamental question of due process and fairness under human rights legislation. It adds a serious constitutional dimension to the debate about sanctions.
Finally, ICAEW also weighs in on broader disclosure and the publication of details concerning tax advisors. What are their views on HMRC sharing information with professional bodies and on publicly naming advisors who have been sanctioned?
Okay, two distinct points there. On disclosure to professional bodies like themselves,
Yes.
ICAEW actually says they would welcome HMRC making further non-PID disclosures to professional bodies beyond the current formal public interest disclosures, which are for serious misconduct.
They want more information sharing. Why?
They believe this would provide professional bodies with more timely and granular intelligence about competence or conduct concerns that don't meet the high threshold for formal misconduct. This would allow the bodies to support its members better and raise standards proactively through education, training, or early intervention.
Okay. But they note a barrier.
Yes, they note that this would require legislative change to enable HMRC to share such information without breaching its strict duties of confidentiality.
Right. And what about the second point, publicly naming and shaming advisors?
On publication of details, ICAEW believes publication should be reserved for the most serious cases where a penalty is charged, specifically for dishonest conduct, perhaps. Not just for mistakes, and certainly not for cases where no penalty is eventually levied.
Why such caution?
They are particularly concerned about the government's contemplation of publishing an agent's name simply for making mistakes, even if no penalty is ultimately chargeable. This is due to the potential detrimental and potentially catastrophic reputational impact on an advisor's business.
Public naming could effectively end a career or a firm.
Potentially, yes. They call for fairness here, stating, there needs to be some independence in the decision-making process, both for the level of sanction and a decision to publish.
Independent oversight again.
And they emphasize the need for a continued right of appeal to an independent tribunal against publication, ensuring that such severe reputational damage is only inflicted after robust, independent scrutiny.
This deep dive truly highlights a profound philosophical and practical divide, doesn't it?
It really does.
It brings us to the core tension at the heart of this entire discussion. Do we really want to give HMRC more powers? And crucially, how far is too far? This question was central to a fascinating debate held by the Chartered Institute of Taxation, CIOT, and the Institute for Fiscal Studies, IFS, aptly titled HMRC's Powers Going Too Far.
Yes, that debate really crystallized the opposing viewpoints. It's fascinating how clearly the arguments for and against more powers were articulated, drawing quite stark lines in the sand.
Who argued for more powers?
Jim Harrah, who was Director General for Business Tax for HMRC at the time, argued for more powers. He emphasized that HMRC is legally accountable to Parliament, meaning their powers are subject to democratic oversight.
Okay.
He stressed that a small minority of cheats require a considerable amount of HMRC's resources to ensure compliance, and therefore, his argument went, HMRC require modern new enforcement powers to ensure minority comply.
Modern tools for modern cheating, essentially.
That was the gist. He argued that while tools change with society and the nature of noncompliance evolves, these powers should be subject to safeguards and used proportionately, a point he continually reiterated.
And he mentioned the practical benefits.
Yes, a key practical point he made was that DRD, specifically, will be much cheaper for HMRC than traditional, often court-based debt recovery methods. He estimated a significant return, 17,000 cases of, on average, £5 8K equals 98 million recovered annually, thus justifying the efficiency gains.
98 million. But those against more powers have strong historical and constitutional arguments, don't they?
They certainly do. James Bullock, who was head of litigation and compliance at Pinsent Mason, referenced Magna Carta, no less.
Magna Carta, wow.
Arguing that any move to enabling legislation without the courts is against constitutional principles. He emphasized that the fundamental principle of self-assessment is that taxpayers, not HMRC, self-assess, and this carries checks and balances through the court system.
So DRD upsets that balance?
In his view, yes. He squarely stated that DRD gives HMRC a power without independent scrutiny, fundamentally altering the balance of power between the state and the individual citizen. A very deep, almost philosophical objection.
Were there other voices in favor?
Jolyon Maugham, a barrister from Devereux Chambers, also weighed in, arguing for ramping up collection. He acknowledged that whilst many believe that HMRC is too chaotic to be trusted with DRD, there are lots of reasons to ramp up collection.
Like the amount of unpaid debt.
Exactly. He cited the staggering figure of some 4.4 billion Han lost in tax debts for noncompliance, a significant sum that, he argued, needs addressing.
And he mentioned safeguards, too.
Yes, he reiterated that DRD will come with safeguards, like not applying if a debt is genuinely in dispute, requiring 9 fair warnings before action, and crucially, mandating that HMRC must leave £5,000 in the bank account or more if needed for living costs.
And comparisons with other countries.
He pointed out that similar powers exist in other countries, and that HMRC already has powers to seize assets in some circumstances, so in his view, no Rubicon will be crossed in terms of unprecedented state power.
But on the other side, another strong voice against.
Philip Baker QC from Gray's Inn Tax Chambers firmly argued against the expansion. He stated that there is a balance of proportionality and taxpayers' rights, and that HMRC is moving closer and closer to using measures which are disproportionate.
And he had that memorable analogy.
Yes, he memorably argued that DRD is the modern equivalent of hanging smugglers as a deterrent. We don't do that. It's a power too far.
A vivid image.
It underscores his belief that while deterring wrongdoing is important, the means must remain proportionate and aligned with modern legal and ethical standards. He also suggested HMRC is unable to put forward an adequate argument for DRD other than it saves them time and expense, implying efficiency alone shouldn't justify such an extensive power grab.
So that whole debate and the questions from the audience really seemed to boil down the arguments, didn't they?
What's truly fascinating is that it distilled down to two core intertwined issues that really encapsulate the broader tension we've been discussing.
Okay, what were they?
First, the constitutional issue, posed as, do we want to give the state the power to dip into our bank accounts, given that they can already hack our phones and computers?
A fundamental question of state power versus individual privacy.
Exactly. What lines, in a modern digital age, should simply not be crossed by the government without explicit, robust, and independent oversight? It speaks to a deeper concern about the evolving nature of the citizen-state relationship.
And the second core issue?
The second was the practical issue, phrased as, can we trust HMRC with DRD? It is all about cutting costs for an apparently very low amount of tax and abundant evidence of high levels of error in HMRC's calculations.
So this directly challenges HMRC's operational competence and accuracy.
Precisely. It implies that while the powers might be theoretically justifiable to some, their practical application could lead to significant injustice due to systemic errors within HMRC itself.
And the sources provide quite compelling and, frankly, pretty concerning examples that illustrate this practical concern about HMRC's reliability, don't they?
Absolutely. And these are critical points that fuel public skepticism, you have to say. TaxAid, the charity assisting vulnerable taxpayers, submitted that in nearly all debt cases, it handles HMRC has got its figures wrong.
Nearly all. That's worrying.
It suggests a potentially systemic issue with accuracy in their debt calculations, raising serious red flags about the potential for erroneous DRD actions, if that's the case.
Any other examples?
Furthermore, there was a Times leak regarding the infamous Liberty Tax scheme. It suggested that HMRC may potentially demand £1.2 billion in unpaid taxes from users of that scheme, but then apparently failed in cases worth several million to issue enquiry notices within the statutory time limit.
So huge potential demand, but then failing to act correctly on existing powers.
An instance of apparent inefficiency or missteps in deploying existing powers effectively, according to that report. And perhaps most strikingly, HMRC's former chief executive, Lynn Homer, had to apologize publicly for a massive $1.9 billion error in HMRC's performance reporting.
$1.9 billion error.
A truly staggering figure that certainly doesn't inspire universal confidence in their internal systems, data integrity, and calculation accuracy.
These examples really lead back to that pertinent question raised by ICEW and others about the array of existing HMRC powers.
Exactly. Powers they already have for tackling noncompliance. For instance, they already have robust penalty regimes for enablers of offshore tax evasion or noncompliance under Schedule 20 of the Finance Act 2016.
Okay.
They also possess significant powers regarding corporate offenses of failure to prevent the facilitation of tax evasion under Part 3 of the Criminal Finances Act 2017.
So they're not exactly powerless now.
Far from it. The central question that arises from this whole debate, then, is why HMRC feels it needs more powers, especially powers that significantly reduce independent oversight, when there's abundant evidence of challenges in fully and accurately utilizing the considerable arsenal they already wield.
Is this truly about enhancing capabilities?
Or is it about bypassing existing, perhaps more cumbersome but arguably crucial checks and balances for the sake of administrative ease? That seems to be the heart of the critical perspective.
What an incredible journey into the shifting landscape of tax powers. We've really covered a lot of ground.
We certainly have.
We've seen how HMRC's powers are evolving from the direct recovery of debts and these new financial information notices to a broader push for enforcement against what they term non-compliance. It's a really complex picture, isn't it? One that requires a careful balancing act between the government's legitimate need to collect taxes efficiently,
which no one really disputes in principle,
and the crucial concerns about individual privacy, fundamental taxpayer rights, and, as ICAEW highlighted, the potential far-reaching impact on the wider tax advisory market.
Indeed. And this deep dive really leaves us pondering a critical question, I think. What stands out to you, our listener, about how this balance between government power and individual financial privacy is shifting in the UK right now?
That's a great question to leave people with.
As these changes roll out and become embedded in the system, understanding them isn't just about ensuring your own personal compliance, it's about being an informed, engaged citizen in an increasingly data-driven world.
Where the lines between public and private financial information are definitely getting redrawn.
Rapidly. We encourage you to continue exploring these critical areas and consider their implications for your own financial life, yes, but also for society as a whole.
Absolutely. And if you found this deep dive helpful and informative and you'd like to support us in continuing to produce them,
We'd be very grateful.
please consider buying us a coffee. Your generous support really does help us continue to bring you these detailed analyses and deep dives into the topics that truly matter. You'll find the link to support us in our bio or show notes.
And once again, this deep dive was produced for you by Expert Trader UK. Thank you for joining us on this, well, I think, quite enlightening journey.
Thanks for listening.